Welcome back to Factful Finance, where we turn complex financial concepts into actionable strategies for success. Let me ask you something. Have you ever thought about how Wall Street pros manage risk? What if I told you they often use a secret weapon to protect their investments, or even profit from market swings? That secret weapon? Futures contracts. If you're scratching your head, don't worry. By the end of this video, you'll understand exactly how futures contracts work, why investors use them, and how they can fit into your financial strategy. Let's dive right in. Futures contracts are agreements to buy or sell an asset at a future date for a price that is agreed upon today. Sounds simple, right? But these contracts are far more powerful than they appear. They're used by investors to hedge against price fluctuations in everything from commodities like oil and wheat to financial assets like stock indices. Here's how they work. Imagine this. Olivia is a farmer in Kansas, and she's expecting a bumper crop of wheat this season. The problem? She doesn't know what the price of wheat will be when harvest time comes. If wheat prices drop, she could lose big. So Olivia enters into a futures contract with an investor. The investor agrees to buy her wheat at a set price in 6 months, locking in the price today. For Olivia, this secures a stable income despite market uncertainty. For the investor, it's a bet that the price of wheat will either stay the same or increase. If wheat prices fall, the investor gets to buy it at the higher, agreed-upon price and could make a profit. This contract benefits both parties. Olivia has security, and the investor has the potential for profit. But here's the kicker. Futures contracts aren't limited to farmers or big institutions. They can be used by anyone to hedge risk or speculate on market movements. Let's break this down further. In its simplest form, a futures contract involves two key players, the buyer and the seller. The buyer agrees to purchase the underlying asset at a specified future date. The seller, in turn, agrees to deliver the asset at that date for the agreed-upon price. It's crucial to note that most of these contracts are settled in cash rather than by actual delivery of the asset, especially in financial futures, like those tied to stock indices. So, what the buyer and seller are really betting on is price movement. If the price goes in the direction the buyer expects, they profit. If not, well, they take the loss. Now, why do investors love futures contracts so much? They offer two big benefits: leverage and liquidity. Futures contracts allow investors to control large amounts of an asset with a relatively small initial investment. For example, if you wanted to buy a future on 1,000 barrels of oil, you don't have to come up with the full price of the oil. Instead, you put down a margin, a small percentage of the total value. This leverage amplifies both the potential returns and the risks, which is why futures are often seen as high-stakes financial instruments. Liquidity is another major advantage. Futures contracts are traded on major exchanges, such as the Chicago Mercantile Exchange, meaning there's always a market for them. Whether you're looking to hedge, speculate, or just bet on the price of gold, you'll find buyers and sellers ready to make a deal. But here's the thing. Futures contracts aren't for everyone. They can be incredibly risky, especially if you're using leverage. For example, Henry, an amateur investor, decided to take a chance on a futures contract tied to the S&P 500 index. He didn't fully understand the risks involved, and when the market dropped unexpectedly, he faced a massive loss. If you're considering futures contracts, it's essential to fully understand what you're getting into and to have a solid risk management strategy in place. So, how do these contracts tie into larger financial strategies? Investors use futures in a few key ways. 1. Hedging. This is the primary use. If you own a large portfolio of stocks, you can use futures to hedge against a potential market downturn, essentially ensuring your losses are capped if the market moves against you. 2. Speculation. Investors can also use futures contracts to make a bet on the future direction of a market. For example, Ava, a commodities trader, might speculate that the price of gold will rise in the next 3 months. She buys a futures contract today and hopes to sell it at a higher price when the contract expires. 3. Arbitrage. Some investors use futures to exploit price discrepancies in different markets, capitalizing on minor inefficiencies. But as we wrap this up, let's go back to the bigger picture. Futures contracts, like all financial tools, are just that, tools. They are incredibly powerful, but must be used with caution and strategy. They can be a key part of your risk management or a way to amplify your returns. However, they're not a set-it-and-forget-it kind of investment. If you're new to futures, start small, do your research, and if necessary, consult a financial advisor. This content is for educational purposes only. Mentioning any apps, products, or services is not an endorsement. Always consult a certified financial professional for personalized guidance. Which aspect of futures contracts interested you the most? Was it the potential for leverage, or how investors use them for risk management? Let me know in the comments below. I read and respond to as many as I can. And if you found this video helpful, there's more where that came from. Make sure you're subscribed so you don't miss the next deep dive into the world of finance. If you found this valuable, you'll love our next video. Don't miss it. Click the video on screen.